So I got this comment on my escape velocity video. It's such terrible advice, saying that you should strive for more than 9% is delusional. Delusional beyond belief. You're not the best investor in the world, and you won't be. Stay with realistic 78% long term, and maybe you'll get lucky and get like 20% a few years. So effectively this comment is just saying strive to be average. Do not expect more. It's delusional. It's unrealistic. Trying to do better is impossible. This is Wall Street dogma. Yeah, they tell you can't beat the index, so buy the index. They sell you the index. And I'm going to show you in this video exactly how it is. It is absolutely possible. However, many of you might not like the answer. And that's fine. And that's totally fine. I don't care. I'm not here to try and convince you to do anything. I'm not here to convince you to buy any stocks. I don't care. I've got nothing to prove. I learned this information from the best investors in the world. Warren Buffett uses this method, and the math proves it time and time again. So in the escape velocity video, I lose 9%, 12%, 15%, 20%. Because I put that 20% escape velocity, people were going crazy. You know, the total pedantic people in the finance space are like, you can't do that, it's impossible. You have to buy an all-world fund and just hope, pray and manifest that it does okay. And I'm saying no. I refuse, I reject this comment. It's not delusional at all. It's just because this person doesn't understand what he's actually investing in. People think, honestly, they think the stock market is like picking a stock is a lottery ticket. It's a complete lottery ticket. It's a gamble, pie in the sky, hope for the best. And that's because most people that try and pick a stock, they care more about being right first than just being right. They pull these low cap, non-profitable companies that they found on Reddit and say, yeah, but this is going to go to the moon. Bro, buy this stock. And it's trash. It's complete trash. They don't have a clue what's going on. And yeah, those people lose. Okay, outperforming the market on a nominal basis where you pick a stock and the stock, your portfolio nominally outperforms between January and December. Okay, yeah, that's impossible. I'm not saying that. I am saying, look at the business. And we're going to show you some businesses. I've got a few examples here. And I know the first thing people are going to say is, well, you're picking companies that have already won. That's exactly the point. That's exactly the point. So what we're going to use is owner's earnings. When I look at a company, I use owner's earnings. Term was coined by Warren Buffett in like 1980s. When you look at owner's earnings, this is the source code. So if you look at the actual owner's earnings, the company, the stock price must follow. It must follow. Now, disclaimer. Everything before I go into this, disclaimer is, well, I'm not telling you what to buy. I never tell people what stocks to buy. I hate the borrowed brain, borrowed conviction. I hate that. This channel's not about giving out a shopping list. This only matters if you pay fair market valuation. If you buy the stock and it's 1,000 PE, you deserve to lose all your money. Yeah, you're buying a company with zero margin of safety. The entry valuation is the most important part of investing. That is it. Entry valuation, the most important part. So this is all assuming you pay fair market valuation. If you don't, this doesn't work. So what I'm trying to show you here is the owner's earnings compounded, stock price must follow. Now, people will say, oh, that's obvious. If it's so obvious, why don't you do it? Yeah. Oh, but a company must follow its stock price. This is Peter Lynch. Everyone says the same thing, but I'm using owner's earnings. This is the trick. This is why it's so important. What is owner's earnings? Operating cash flow minus maintenance capex. Maintenance capex is the cost of keeping the business alive. Then all that free cash flow that's left is for shareholders. So if a company doesn't have any free cash flow, shareholders are on hold, and Wall Street doesn't like this, and Wall Street sell the stock. We saw this a few days ago with Google. Google Q2 just reported earnings, negative free cash flow, stock drops -7%, but the owner's earnings is different. It's how much was discretionary spend. If the company says, yeah, we've got like 100 billion in money here, we're going to spend it on whatever we want. We're going to build a data center, whether you like it or not. That is discretionary. That's optional to spend that money. We can't punish a company for spending that money. So look at Amazon. Amazon compounded at 40%. If you start from 2014, if you start from 2015, it compounded owner's earnings at 33.4%. And look at the stock price. The stock price just about matches it. Yeah, so what I'm saying is, if you only look at the actual company's earnings and ignore the stock price, completely ignore the stock price unless for entry valuation. If you ignore the stock price and only care about owner's earnings, are they growing? It's a mathematical certainty. If it's sustainable for that stock, if it is sustainable for the type of business, I'm not talking about memory companies or whatever, things like that. I'm looking at companies with solid moats, pricing power, structural moats. Okay, so Amazon's one example. Broadcom, right? Broadcom. Before AI, right? Everyone thinks Broadcom's just, Nvidia's little brother. For 10 years, the company's earnings have outperformed the market. Yeah, so I'm looking at owner's earnings. From 2014 to 2024, for 10 years, the owner's earnings compounded at 43.79%. That is the cash, money in the bank. Broadcom's a better example because it doesn't have maintenance capex, so it's so simple that usually the free cash flow is the owner's earnings. It's the same for like Nvidia, because they don't have maintenance capex, they don't have big warehouses to fix and replace and build, and that's why it's such a profitable company. Owner's earnings per share. That is the absolute source code. Owner's earnings per share, because you can't buy the full company, but you own a share. And what you'll notice is, why is the absolute owner's earnings higher than the per share? But it could often be they might issue stock. If they issue stock to buy something like VMware, like Broadcom did, that's fine because that's going to generate more money in the future and our owner's earnings will go up in the future. But look at the actual spread between the stock price and the owner's earnings per share. It's exact. The stock price matches it perfectly over a 10-year period. Yeah. Over a 10-year period, it matches perfectly. I just look at owner's earnings. Owner's earnings from 2015 to 2025. Look at that, 42% compounded growth. This is before AI was a buzzword. This company was still doing this. And also, I will also look at other things in the company, but in this video, I just want to focus on owner's earnings, not like ROIC or anything. But look, the stock price matches owner's earnings per share and the stock price over that period. It literally is a perfect spread. Yeah. Now, obviously, people will have an excuse for everything I say in the video. They'll hang on every word and say like, yeah, but it might not do that in the future. Okay, well, what else are you going to go off of? What other choice do you have? What's your alternative? Just buy the index, right? Fine. For people that want to, right? Okay, see, if you're someone who's very busy, you might be like a lawyer, accountant, doctor, or you're working 8 hours a week, you just physically don't have time to check this information. I don't have anything against that. Yeah, buy the index if you want. There's other indexes you could buy. You can still get a higher return as long as you pay fair valuation. But if you want to do better than average, if you actually want to do better than average, this should be like an epiphany, because I wish someone had explained it to me this way. Because most people that just buy stocks, they look at the stock chart and say, is it green? Oh, it's up 50% for the year, I'm going to buy it. They're actually buying it when it's at most danger. There's no margin of safety when you're buying it when it's ran up, unless it has extreme growth ahead, which is different. But the stock gets safer the more it crashes down. When we're talking about the companies I'm talking about monopolies with pricing power. Like Texas Pacific, this is another one because it's outside of like big tech. This company is simple. It owns 880,000 acres of land. So maintenance capex is nothing. Its biggest asset is water. Right now, this company is extremely expensive because the market's not dumb. They see the same numbers I'm looking at. And again, compounded owner's earnings for 10 years, 28.9%. Owner's earnings per share, 30%. Stock price, 26%. Okay, you see that? And from 2015 to 2025, 28%. Stock price, owner's earnings, 27%. Look how close they are. It's like, this is what Peter Lynch said to everyone, and people just seem to not grasp it. It's so simple. If the company's making money, if the owner's earnings are going up, the stock will go up. So and also buybacks, yeah? So that owner's earnings, they're using their free cash flow for buybacks. That's what Wall Street like to see. And that's another example. Here's my favourite. My favourite is Meta. Okay? Meta is a fantastic example because it's literally a coiled spring right now as we speak, because the owner's earnings are going higher than the stock price. Now, fake owner's earnings is like what technically Wall Street use just free cash flow. But again, if Meta just spent all its money on a data center and there's no free cash flow, it looks like there's no money. But that was discretionary. Discretionary plus buybacks. They're reducing the share by 1.44% a year. And let's look at the 10-year from 2014 to 2024. Okay, here we go. So the stock price, how do I fix that? It's too wide. 28% operating cash flow. Operating cash flow is really what you should be. I look at, because I'll show you something. Use Broadcom as an example. Right, your PE ratio, your price to earnings ratio, is off of net income. However, what if the operating cash flow is higher than the net income? Then it means the price to earnings is a lie. Let's look at this. Okay, so for the last quarter for Broadcom, its net income was 9 billion, but its operating cash flow was 10 billion. There's more cash in the bank than net income. That's because of amortization gets added back, because they're writing off the purchase of VMware, which is a software. They have to depreciate it, but it's just software. It doesn't actually depreciate. So the actual cash in the bank is higher than the net income. So everyone, that retail investors might just look at a P ratio, trailing price to earnings ratio, and say, okay, that's expensive or it's cheap or whatever. But look, the actual cash they have, cash is what pays for buybacks. Cash is what matters. Again, Warren Buffett, cash is king. GAAP accounting's a lie. EBITDA is a BS number. So what you see here is the stock is lagging the owner's earnings. Yeah, so 22% on the stock. It's actually lagging the true owner's earnings per share, which is 30%. See, Meta is so asset light. It doesn't have like a big warehouse and all these vans or whatever and logistics they need to maintain. It's a software company. So there's so much cash for buybacks. So they buy back the shares, which increases your owner's earnings per share. And there you go. There's a coiled spring. See, the numbers really should match, but right now the market's punishing it, and it will continue to punish it. And that's it. This is what I'm saying. This isn't like I'm making this stuff up. I learned all of this through the financial academia. That retail investors do not even care about any of this stuff. But this is where all the alpha is. All these boring spreadsheets is where the alpha lies. So when someone comments saying that it's delusional and it's impossible, they just have a weak mindset. They don't believe they're capable of more. That's fine. If you want to be, if you truly believe your potential is just average, then so be it. You know, this channel is not for you. My content is not for you. And I'll show you, the door is up at the cross of the tab. Yeah, FICO. Right. So FICO is like right now. So FICO is an example of it's too expensive. So it's the opposite of a coiled spring. It's the opposite of Meta. But operating cash flow, free cash flow. This is FICO's very asset light as well. So let's look at the 10-year analysis. I mean, it compounded, owners' earnings compounded at 18%. So it smashed the hurdle, but the stock price actually went 37%. So the stock's going up way more than the actual owner's earnings. It means that it's trading unrealistic valuation. It's too expensive. Yeah, margin expansion. It's just, I wouldn't buy it. It's a good company, but if it's too expensive, I wouldn't buy it. That's the whole point. That's the whole game. This is the whole game. Of course, Google. Of course. Yeah. And again, people say, but you're just picking companies that have already ran. They say that it's like, okay, that's welcome to the whole game. This is the game. Google is expected to double its net income by 2028. This is defying all traditional view of the law of large numbers. If it's too big, it grows slower. That's the old myth. But we live in a digital economy. For Google to grow its bottom line, it could just run an extra ad on YouTube to 1 billion people. More advertising income, boom. And that cost them literally nothing. Whereas most businesses, like an automobile business, needs to build another factory, which costs them like millions, and they need to hire more staff, and then they need to buy more infrastructure. So growing it is so slow. But we don't live in that economy anymore. We live in a digital economy. Net income to double. This is what Wall Street are anticipating because of various reasons. As you can see, cloud infrastructure, AI. That's the projections at the moment for Google. So for someone to say, well, this company's already ran and you've missed the boat. They think we're buying like altcoin cryptocurrency or something. No, it's not the same. So Google compounded at like 24% stock price, owner's earnings per share 21%, almost like a direct connection between the company's earnings and the stock price. What would you believe? Yeah, unbelievable. This is what I'm saying. This is the coiled spring investment timeline. Now, the whole point of this, yeah, is you invest in these companies and you think that from January to December, the stock's fully flat. Nothing happens on the company. Someone would say, yeah, you haven't outperformed the market. Okay, yes, the investment has not outperformed the market. But the business has. Yeah, the business has. So we just quoted about the owner's earnings. I mean, let's go back to Meta because Meta's the best example here because it's the only coiled spring. So yes, okay, someone would say, yeah, haha, you didn't outperform the market, you thought you were a genius, but the actual company grew its owner's earnings at 28% year over year, which is ridiculous for a company to do. And if the market says no, Wall Street don't play ball, it stays flat. And another year goes by, and another year goes by, and another year goes by, the company's still growing, the financials are amazing, and Wall Street still don't play ball. Let's imagine if you owned a company and the stock market didn't even cooperate at all. So we own Meta, so Wall Street says they hate it, they hate Zuckerberg, they hate the company, and everyone boycotts it, refuses to buy it. What actually happens is it becomes so much of a coiled spring that eventually what would either happen is they would just fish out so much dividends to you as an investor, or the actual company would get sold to a private equity firm because they would look at it. The private equity firms do this all the time, but they find companies on the public markets that are completely coiled springs that the market's ignoring, and they would just buy the business. Or big super investors, like your massive, huge institutional hedge funds, they would actually buy like 10% of the company because it's so cheap, and they would just overthrow the board and say, look, you do buybacks right now. You need to do something with all this, just a giant pile of cash on the stock market. They would take over the company, do that, or it would get sold to private equity, and you would get a little email in your broker account saying, do you agree with the sale? and your stocks would get sold to a private equity, like it would just get sold off. But that would never happen, because the math has to correct itself. It has to correct itself. It can't just sit generating so much cash and the market doesn't correct it. So the stock could sit flat for 5 years and then goes up 100% on year 5. Have you outperformed the market for the last 5 years? Of course you have. People, it's not about trying to decide what the stock's going to do tomorrow. You don't just pick a stock, and that's what people think it means. Or you think you're a genius, you have to pick the next Nvidia. That's not what I'm saying. And it's not about that. Who just bought Google recently? Who invested in Google recently? Berkshire Hathaway. And many people would say, I see, they're 22 years too late. No, they're just right on time. They're right on time. These companies are still growing. Unless you truly believe that all these companies I'm talking about, and all these, I could have done a list with 20 companies. I could do a whole playlist on this. You just have to say, you do not believe these companies can continue to grow. That's it. But I mean, you already, the hyperscalers and the big tech, if you're owning the market anyway, whether you own an all-world fund or whether you own the S&P 500, 40% is already in, dependent on these companies anyway. So you actually just own these companies anyway. It is possible. It's not delusional. I don't care if you think it is. I don't have a problem if you want to just invest in an all-world fund. But the reality is, it doesn't protect you from volatility as you think it does. Black swan event hits, COVID hits, your portfolio, you're going to see your portfolio go down anyway. Yeah, I'll see it go down more if I own Google, but it will recover. That's it. This is the game. It's a mental game. It's simple, but it's not easy because everyone would do it. Yeah, but we've got access to information now that we didn't have access to. Back in the day when Benjamin Graham had to get a 10k report on a company, he had to walk to the actual company and ask for a 10k report. We now have instant access to this information. And it's that simple. I mean, you might say, okay, I'm too busy, I need to invest in an all-world fund, I don't have time to do all this stuff. I say that's fine. That is fine, but look at the actual escape velocity of a high return. You literally could shave 10, 15 years of your own labour by learning this. Just a learning curve of what is owner's earnings. How to do a fair valuation, to check the valuation. So, yeah, I will put more information as far as actual entry valuations, because that's the most important part. I keep saying, I enjoy doing that. I will put out on the newsletter, when I value a company, I'll show you my valuation on it, because there's a million different ways people value it, and all you need to do is make a decision. Do I agree with Chris or not? That's it. Because I'm never going to be the guy, this channel will never be the guy who says, buy this stock. Because you know what? When you first start investing, that's the attitude most people have when they're beginners. And the more you start to realise and learn, telling someone what stock to buy is just, it's terrible to do, because borrowed conviction never works. It never works, because someone might have high conviction in a company and they tell their friend about it. Their friend doesn't have conviction, they're just borrowing from the friend, and who are they going to blame when the stock goes down and they don't understand this stuff? They're going to blame you. So it's not going to be that. I'm not going to hear, here's a shopping list, and you do no work. Come on, you got to have some conviction. But yeah, this channel is not designed to be for everyone. The channel, I know, is going to cause conviction, a lot of negative comments and stuff. People saying it's delusional. I don't care. I couldn't care less. Do your own thing. You don't need to watch the video. You don't need to watch the channel. You don't need to comment on the channel. Go and watch traditional financial advisors who will tell you to do a 60-40 portfolio. They're the same people that told you to buy bonds in 2019, 2020. when bonds were like yielding 1% and had no other way to go, had no margin of safety, and they get away with it because they care about themselves, they care about their own job. You're not the priority. Their priority is to keep their job. Anyway, I'm going off on a rant. There you go. That's the owner's earnings coiled spring method.